Hello, everyone. Welcome to the market opening bell for Wednesday, October 15, your 10-minute guide to the stock market. China's Ministry of Commerce implemented countermeasures against 5 U.S.-related subsidiaries of Hanwha Ocean Co. Limited starting yesterday, escalating Sino-U.S. trade tensions. Meanwhile, late last month, the Dutch government issued an administrative order citing national security to impose global operational restrictions on Nexperia, a Dutch subsidiary of Wingtech Technology, and its affiliated entities. Reports indicate that Chinese authorities have responded with measures including an export ban on products from Nexperia's Guangdong factory and its subcontractors. The Hang Seng Index opened 79 points higher, briefly rising 213 points to 26,102 before turning downward. It fell as much as 557 points to 25,331 in the afternoon, closing down 448 points or 1.7% at 25,441, marking 7 consecutive trading days of decline. Cumulative drop of 1,845 points or 6.8%. The X-share index fell 143 points or 1.6% to 9,079, while the Hang Seng Tech Index dropped 222 points or 3.6% to 5,923. Total market turnover was 398.9 billion Hong Kong dollars. Southbound trading turnover reached 181.2 billion, with southbound funds recording a net inflow of 8.603 billion dollars, including net buys. CSOP Hang Seng Tech Index ETF at 1.147 billion Hong Kong dollars. Xiaomi 923 million, Tencent 662 million, XTAL Holdings 426 million, PopMart 399 million. Net sales include SMIC at 957 million, Alibaba 795 million, Innovent Biologics 767 million, ZTE 645 million, Kuaishou 253 million, Tracker Fund 239 million, Hua Hong Semiconductor 110 million. Statistics show southbound funds have net bought Xiaomi for 7 consecutive days, totaling 5.632 billion Hong Kong dollars, while reducing holdings in SMIC, totaling 6.586 billion dollars, and Alibaba totaling 4.979 billion for 4 consecutive days. Technically, the Hang Seng Index is 145 points shy of fully closing Monday's gap between 26,247 and 25,895. Caution is advised if it falls below the 2-day low of 25,330, potentially testing 25,000 near the 100-day moving average. On the Asian market, the 3 major A-share indexes opened higher but fell significantly. The Shanghai Composite lost 3,900 points, closed at 3,865, down 24 points or 0.6%. The Shenzhen Component closed at 12,895, down 336 points or 2.5%. And the Chinex Index closed at 2,955, down 122 points or 4%. Total turnover in Shanghai and Shenzhen was 2.58 trillion yuan. The renminbi US dollar central parity rate was lower by 14 points to 7.1021. Recently, foreign institutions have intensified A-share company surveys, swiftly allocating funds post-survey, signaling confidence in the long-term value of Chinese A-shares. According to Wind data from September to October 13, 254 foreign institutions, including Goldman Sachs, Morgan Stanley, and BlackRock, conducted 648 surveys of A-share companies, with 0.72 asset management leading at 20 surveys. Meanwhile, Morgan Stanley's latest report shows net foreign inflows into Chinese equities rebounded to 4.6 billion US dollars in September, the highest monthly inflow since November 2024. Back to the Hong Kong market, solar energy stocks rose against the trend. Mainland media reports suggest upcoming significant policy announcements with new progress in addressing industry overcapacity. Relevant authorities may issue a notice on strengthening photovoltaic capacity regulation. The Double 11 shopping festival kicked off early this year. JD.com launched its Moonless Night channel last Thursday, October 9th at 8 p.m., marking the start of its Double 11 campaign. This year's early start reflects consumer fatigue with pre-sales and complex promotions, aiming to allow merchants to achieve sales growth more comfortably. JD.com has abandoned the pre-sale model, opting for direct sales. According to CCTV data, JD.com's app active users surged 47.6% year-on-year on October 9th, leading the industry. Since then, orders for appliances, phones, digital products, and computers have grown over 70% year-on-year, with explosive sales growth across categories. Exclusive customized products saw transaction volumes rise over tenfold, while appliances and furniture saw new product sales increase over fourfold. Nearly 2,000 fashion, beauty, and sports brands and merchants recorded transaction growth exceeding 200% year-on-year. Baidu will hold its annual technology and product conference, Baidu World 225, on November 13 in Beijing, focusing on three themes: the technological depth of large models, the ecosystem breadth of AI native applications, and the global vision of its overseas strategy, seen as a key milestone for Baidu's next decade. On earnings alerts, New China Life Insurance issued a positive profit alert, expecting new profit attributable to shareholders, expecting net profit attributable to shareholders for the first three quarters to range from 29.986 billion yuan to 34.122 billion yuan, up 9.306 billion to 13.442 billion yuan, or 45 to 65% year-on-year. Shandong Gold also issued a positive profit alert, expecting net profit attributable to shareholders for the first three quarters to range from 3.8 billion yuan to 4.1 billion yuan, up 1.73 billion yuan to 2.03 billion yuan, or 83.9% to 98.5% year-on-year, driven by optimized production layouts, improved efficiency, resource utilization, project progress, and rising gold prices. Suanzhu Biopharmaceutical, stock code 2575, which will debut today, closed at 31.46 Hong Kong dollars in Phillip Mark's grey market yesterday, up 171.2%, or 19.86 Hong Kong dollars from its IPO price. Excluding fees, a 500 share lot would yield a paper profit of 9,930 Hong Kong dollars. On Tuesday, US President Trump criticized China for refusing to buy American soybeans and threatened to terminate trade in edible oils with China, triggering a late sell-off in US stocks. The VIX, known as the Fear Index, rose 1.78 points or 9.4% to 20.81. The Dow Jones Industrial Average fluctuated over 1,000 points during the day, dropping more than 600 points early on before rebounding over 450 points, ultimately closing up 202 points or 0.4% at 46,270. The S&P 500 ended down 10 points or 0.2% at 6,644 after volatile trading, while the Nasdaq fell 172 points or 0.8% to 22,521. The Nasdaq Golden Dragon China Index, reflecting Chinese stocks, dropped 161 points or 1.85% to 8,114. Nvidia fell 4.4%, Tesla declined 1.5%. Nvidia announced that its smallest AI supercomputer, the DGX Spark, has begun shipping globally. CEO Jensen Huang personally delivered the first batch to Tesla CEO Elon Musk, echoing his 2016 delivery of the first DGX-1 to OpenAI. The DGX Spark is available for pre-order starting today at NVIDIA's official website. This new desktop AI system delivers up to 1 pflop of AI computing power and 128 gigabytes of unified memory. enabling developers to run AI model inference with up to 200 billion parameters or fine-tune models with up to 70 billion parameters locally, marking the entry of AI computing into the desktop era. NVIDIA stated that the DGX Spark offers data center grade performance, powered by the company's GB10 Grace Blackwell superchip, Connect X7 networking, and a software stack. It aims to make AI computing accessible to small businesses and developers without the need to spend thousands on AI data center services or custom AI servers. Bank stocks performed strongly, with Citigroup and Wells Fargo exceeding third quarter expectations, the shares rising 3.9%, 7.2% respectively. JP Morgan Chase and Goldman Sachs also reported solid earnings, but saw their share prices decline. Citigroup announced record third quarter results with net profit up 15% year over year to $3.8 billion or $1.86 per share, and revenue up 9% to $22.09 billion, surpassing market expectation of $21.09 billion. Service business revenue hit a record high, up 7%. Banking revenue surged 34%, and markets revenue grew 15%. Federal Reserve Chairman Powell, speaking of at the National Association for Business Economics conference, indicated that the Fed might pause its balance sheet reduction in the coming months. He noted a continued deterioration in the job market outlook, but provided no clarity on long-term interest rate trends. Amid rising expectations for a Fed rate cut this month and escalating US-China trade tensions, investors shifted to safe haven assets. Spot gold hit $4,179.7 and December gold futures reached a daily high of $4,190. The International Energy Agency warned of a severe global oil supply surplus by 2026, causing oil prices to fall over 1%. Our stock pick today is AEON Credit Service, stock code 900. Facing challenges such as subdued consumer sentiment, high interest rates, and rising credit default rates, AEON Credit Service adopted a more conservative strategy for sales and receivables growth. The company prioritized maximizing returns from its credit card and personal loan portfolios, while reducing credit risk, achieving slight revenue growth. This demonstrates the resilience of its core business and the effectiveness of measures implemented to sustain sales and receivables growth. For the 6 months ended August 31st, 2025, the group's revenue grew 4.4% year-on-year to 897 million Hong Kong dollars, primarily driven by credit card sales growth, which offset a decline in personal loan sales due to more cautious credit assessments. Despite a conservative marketing approach, total customer loans and receivables continue to rise, increasing by 2.7% from February 28th to 2025 to August 31st, 2025, reaching 7.524 billion Hong Kong dollars. Net interest income was 698 million Hong Kong dollars, up 4.3%. Fee and commission income rose 8.8% to 67.6 million dollars, driven by significant increases in credit card spending, boosting commission income. Growth in the number of merchants and transaction volumes in the credit card acquiring business, and diversified insurance distribution channels with new insurance products, enhancing insurance intermediary income. To address the high credit default rates, the group implemented robust credit monitoring measures to mitigate further deterioration in loan quality. As a result, credit losses, that is Stage 2 and Stage 3 receivables, as a percentage of total customer loans and receivables, decreased from 4.2% on February 28, 2025 to 4% on August 31st, 2025. The group recorded an after-tax profit of $233 million, a significant 37.1% increase with earnings per share rising from $0.4068 to $0.5578. The net debt to equity ratio was 0.7 and the equity to total assets ratio was 54.2%. As of August 31st, 2025, the net asset value per share after deducting the interim dividend was 10.2 Hong Kong dollars, with a price to book ratio of approximately 0.75 times, reflecting the group's solid financial position. The board approved an interim dividend of $0.25 per share, representing a payout ratio of 44.8%, in line with the policy of distributing at least 30% of net profit as dividends annually, resulting in an annualized dividend yield of approximately 6.5%. Looking ahead, the group will focus on sustaining sales and receivables growth, particularly in local and online transactions, while optimizing credit assessment and monitoring processes to ensure a sustainable, high-quality loan portfolio. Marketing strategies will emphasize precision marketing, large-scale promotions, and leveraging incentives to expand market share, especially among younger demographics, while diversifying revenue through increased fee-generating transactions and expanding the insurance intermediary business. Recommended buy price is $7.50, with a target of $8.50 and a stop loss at $7.10. I do not hold the aforementioned stock.